Is life insurance especially good to use for one of these irrevocable trusts?
In what sense?
Okay, in the sense of what you put in and what you get out.
Right. Well, that brings up an interesting point about the federal tax law. Let's go back to our married couple with the 25 million net worth. The federal tax law is established probably as a public policy so that in general a surviving spouse is not going to pay tax on the passing of the first spouse to die. The tax will be deferred until the second spouse to die. So in response to that, the insurance companies have developed a product called a second to die policy.
Okay.
And they underwrite the life of both taxpayers, and they say statistically, okay, we can take the husband and say, okay, he's 65, and so the chances of him dying, and so therefore $1 million of insurance will cost X amount of money. But then when you take into account the wife and say, okay, she might live longer, but not necessarily he might live longer. In general, when you take two lives, both are required to die to get a payoff on the insurance, you're going to get a cheaper premium.
Yeah.
And you don't really need the money, until, at least in theory, the taxes, until the second death. So that's another application of this.
Okay. So, but the point is that for what we hope, and since we're gambling here with life insurance anyway, but what we hope is that for a modest amount of premiums that are paid in, that may have to be reported for gift tax purposes or whatever.
Right.
We have a big benefit then that can grow inside of this insulated
yes.
entity.
So let me give you a real quick illustration. And I just worked on a case recently. $50 million net worth, husband and wife. Husband's 75, wife 65. The recommended amount of insurance is $25 million. And it's a long story, but those are the rough numbers.
Okay.
The insurance premium was $400,000 a year. So if they pay $400,000 a year for 20 years, is $8 million. The chances of the wife, and the husband, frankly, he was kind of toast. I mean, he's not going to make 20 years.
Okay.
But the wife will, maybe. So she'll be 85.
Okay.
And maybe she'll make 90, whatever. They have to keep paying the $400 every year to keep that in force. If they stop paying, the deal's off, and it's a bad idea. But if they pay all the way through, so that's $8 million over 20 years. If she dies then, they get $25 million. So that's a pretty good deal. And when you run the numbers backwards, in that case, it was a sort of a 10% return on investment because the money is paid up front and there's present value. There's all these kind of computations. But I'd say that's a pretty good deal. Now, the argument is, well, if we had the $8 million, what about investing in real estate or investing in our business and so forth? And there's some arguments for other types of investing because this is basically an investment. But you have to take into account the fact that it's going to be tax-free and so forth and so on. Now, the second part of that equation was, how were these people going to pay the $400,000 a year? Well, we have this beautiful new state tax law that's good until the end of next year, until the end of 2012. In addition to this $5 million per person limit on death, this free transfer on death, that can occur during life. Now, in their case, what they were going to do was they were going to take $10 million of their real estate and slide it over into this trust, which is a gift to their heirs. And then this trust would have the real estate, and that would be the generator of the money to pay the premiums. And they would never have to take any more money out of their pocket, presuming the real estate was good and it made sense, and so which of course we made sure of.
Yeah.
So that's another sort of limited time offer, if you will, in terms of the transfer and the gifting aspect of this.
Yeah. So, and the reason why we say limited time offer is, again, we have this increased exemption. We know for 2011 and 2012. We don't know what's going to happen after 2012.
That's correct.
It may stay. It may not.
Yeah, and the funny thing is, time flies, and I've watched the insurance agents work these cases, and I can tell you, the case that I just mentioned, for example, the initial sort of conversation was last fall, was October, and just recently was the approval, because they have to go through, they have a medical underwrite, and it's a big deal. It takes a long time. So my advice to anybody thinking about this, it's mid-year in 11, We have about 18 months to go, and this opportunity will end. If you start the process in November of 2012, it may be, as a practical matter, too late.
Yeah. Okay.
Yeah.
Let's talk for a moment about the crummy rules.
Okay.
So what is this crummy power or crummy arrangement or whatever?
Okay, so here's what happens. So I got this insurance trust over here, and let's say it's not funded by this big real estate thing. It's just sort of sitting in there.
Mm-hmm.
And there's an insurance policy that's owned by this separate legal entity. It's like a company, sort of established by the taxpayers.
Mm-hmm.
It requires so much per annum in premium. So let's call it $20,000 for the sake of discussion. So that means mom and dad have to put $20,000 over here to pay these premiums to keep this going. And at the end of the deal, the policy pays off, and with the second spouse to die, it's $3 million. So the question is, how do you get the money in there, and what's the impact of that? In effect, they have to give the money to their heirs.
Mm-hmm.
Okay? So if they give the money to their heirs, there's a limit. There's an annual limit now, $13,000 per heir. So if there's a $26,000 premium and they got 2 of them and 1 heir, 2 times 13 is 26, and they can pay the thing. They just give the money. Now, what they really ideally would like to do is just pay the premium directly. But due to the way the tax law is written, something totally beyond our control, is if they just do that directly, that would not be a gift eligible for that $13,000 annual sort of free pass, free annual gift.
So in other words, if I just take $26,000 and I put it in this trust directly with no other.
Right. So that's actually that could cause tax problems either now or later.
Okay.
That could be a gift tax now, or it could be a reduction.
So we start accumulating this.
It could be it could be a problem. So in order to mitigate this, there was a case. It was actually in Modesto, I believe, in 1968, plus or minus. Dr. Crummy is a real guy. Crummy with an E-Y.
Okay.
They devised this, his lawyers devised this thing where he would actually give the money to the trustee of this trust, and then they would send a notice to these kids, and they'd say, okay, there's 10 grand here. If you want it, you can have it. And that was sort of a gift to them. But the idea was they were coached. They were said, hey, look, don't really take it. We're going to use it to buy this insurance, which is going to have a way bigger benefit to you than actually taking the money now. And oh, by the way, if you take the money, we'll never do it again.
Okay.
So basically, it's a legal way, which the courts have validated, to circumvent this, what's called a future interest, present interest in a transfer of money.
Okay.
So that's what a crummy thing is all about.
So what I think we should highlight a little bit, though, is that there are requirements.
Correct.
So those notices have to go out, or should really go out,
Yes.
to the beneficiaries.
Yeah.
And if you don't, then you might have a
Well,
problem.
let me give you, for instance, let's say that let's say they have a once-a-year premium obligation due in November 1st. The parents really should give the money to the trustee at least 30 days in advance. And then the trustee writes a letter to the heirs and says, okay, we got the money, you have a right to take it out. And so there's an adequate notice time. Sometimes you can squeeze it as little as 15 days, but it's not, you can't wait till the last minute. You have to have some forethought on this.
Okay. So we have about 5 minutes left here. Okay.
With all this stuff to talk about.
Yeah. All right. I think what I'm going to go next to is just like who manages the trust.
Okay, good question.
I think that's sort of a good basic.
Yeah.
item for us
So
to talk about.
the trust in and of itself is a dry trust, meaning it doesn't really have a whole lot, or it's not technically not dry. It has stuff in it. What it mainly has is this life insurance policy.
Right.
And actually, the life insurance policy could, over the years, have cash value and so forth and so on. Typically, the first thing is the people that are establishing it, they can't be the trustees. You could have adult children of these people be the trustees, or you could name a professional fiduciary, or you could have a bank, and so forth and so on. There's not a whole lot to do. The main thing is to calendar these payments. Somebody has to be the owner of this policy, and that's the trustee. And then somebody has to get the correspondence and say, oh, wait a minute, we got a policy premium due on November 1st. I better call mom and dad and tell them to get their money in. And then I got to send these letters out and so forth and so on. Beyond that, there's not really much happens until the death of the second person.
Mhm.
Or
if you have a second to die
or
clause.
if you have a second to die, or if there's only one person, because some people do this when they're single.
Yeah.
If there's only one person, I don't mean to preclude
Yeah.
single life insurance, because that certainly is a planning tool
Sure.
as well. But at that person's death, then there's a pile of dough in this. There's
Right.
$7 million. Then the question is, what are we doing with it? Are we paying taxes? Are we distributing it? Are we managing it? What are we doing there? So that gets into a different management situation. But during the life of the taxpayer, you're not going to see a whole lot of action.
Okay. How are the proceeds distributed when this insurance pays off?
Great question. So this is a trust, and for those that are familiar with their own revocable living trust, it says when dad dies and mom survives, and it sort of hangs there, and then when mom dies, it goes to our 3 children equally, or maybe there's a trust set up for somebody, whatever. Same kind of thing. Same kind of thing. That living trust has what's called dispositive provisions. The insurance trust also has dispositive provisions. Somebody gets that money.
Mm-hmm.
Okay, so that's the idea.
Okay. How about income taxes? So obviously, well, I'll just sort of ask the question and we can fill it in. So is an annual income tax return going to be required for this trust?
Maybe. The trust is a separate taxpayer. It is separate. It can be set up in such a way to where all of its attributes, let's go back to the real estate example. You got $10 million of real estate in here, and there's obviously going to be rents and the expenses and depreciation, that kind of thing. There's 2 ways to handle that. There's one way where you could set it up to make it, all those attributes go back to the parents who set it up, the taxpayers who set it up. That's called a defective trust arrangement.
Mm-hmm.
And then the other way would be to not have it defective and have this be its own taxpayer and pay its own taxes. But that's a planning decision much beyond the 28 minutes that we have.
Yeah.
So, but there's a filing requirement. There's either a 1040 or 1041 requirement related to the trust assets.
So the reason why I bring this up is that a lot of people think that because I have this arrangement, I don't have to worry about income taxes. And the fact of the matter is that it's not necessarily the solution. That's not the problem that it's there to solve.
Correct.
Okay, and so it can actually generate some taxable income in some circumstances.
Yes.
Like you mentioned, the cash value. In some cases, these policies actually pay out some interest and other things.
Right.
And so there may be some taxable.
Or the trust might have money.
Yeah.
I mean, the trust
yeah,
might have
yeah,
some
well,
money.
we mentioned the real estate activity for generating, for paying a premium.
Right.
And so forth. Okay, well, we're about out of time, so I think what I'm going to do is let you throw out maybe a final word of wisdom.
Wow. I mean, my first reaction is compute your tax. I mean, the idea is to sit down with a tax advisor and say, okay, if we die today, what happens? Some people think, gosh, I got $1 million. I mean, all these taxes. There's this sort of, well, that's not going to be that big of a deal.
Mm-hmm.
Now, and if the person is, let's say, less than 60, what's the chances of dying by the end of 2012? Not high, probably.
Mm-hmm.
So what do we think the taxes are going to be? So there's a little bit of guessing.
Mm-hmm.
But the main thing is get with somebody and figure out what the exposure is, and then you can consider steps. I mean, the insurance is only one aspect. It can do a lot of these things without insurance.
Mm-hmm.
And there can be a state reduction. That 25 million can shrink to 18 million without insurance by doing some other techniques that would take at least another 28 minutes to discuss.
Okay. All right, folks. Well, I hope we've given you something to think about. The Irrevocable Life Insurance Trust obviously isn't for everybody.
Correct.
So when we're talking about very modest estates,